So Brian, at this point, it sounds like the three buckets as you referred to, the hybrid, the deed, and the lien. It sounds like each one of those have different for the investor side, right? Whether I have $500 in my pocket or 500,000 in my pocket, whatever. My strategy needs to be based off of what bucket I'm jumping in, right? I can't presume to walk into a deed investment market and try to buy a property for, say, $5,000. I mean, I may, it's possible, but the likelihood of that happening is not very high because people are also looking at the value of the property, the potential resale value of the property. They're taking into consideration all of that. You said it's closest to a typical real estate transaction than the lien, where the lien is just a lien. It's it gives an interest in paper, but not, you can't get rid of the property without satisfying the lien. But with a deed, it's a different ball game. So if I'm strategizing, I'm trying to figure out, okay, I'm new to this thing. I need to determine whether or not I'm looking for interest or whether I'm looking to get possession of the property, right? Do I need to think about those things at this point before I even start investing and researching and figuring all this stuff out?
Absolutely. I think it's finding what your end goal is, or defining what your end goal is absolutely what you need to do up front. I'll take a little step backwards and kind of toot our horn a little bit, Carlton, because the lien industry, both tax lien and tax deeds together, is roughly $10 to $12 billion annually that's sold.
Wow.
And of that, it's nothing compared to traditional real estate, which is in the trillions, right? But it's not like it's a very, very tiny industry. Now, the hedge funds, who have been doing this, they really invented the industry as far as an investment strategy since the 80s or earlier. Comprise probably 70 to 75% of all of those liens that are offered. They buy. Taxa Resources provides data to probably 80% of those hedge funds, and so we've seen an amazingly diverse array of strategies, right? And it goes everywhere from, I don't ever want to own a property. I just want to, they call it the arbitrage spread on that interest. I'm going to go get money from the bank at 1%, and I'm going to earn interest from the county at 6 or 7 or 8 or whatever it may be, to the other end of it, which, I want to own the property. I'm going to be willing to bid, interest rates down to zero, knowing I'm not going to earn anything on this lien for 3 years, because I know there's going to be a small fraction of these properties that turn into actual real estate for me, and that's where I'm going to make my money. And so, yes, the long answer to your basic question is defining, your end strategy or your end goal and your model. It will help you define all of these things, and that can be a complicated question. I mean, it could be easily defined as if you don't want to venture outside of your immediate area. Well, certain states only have tax liens, right? If you are going to invest in Arizona, you're only going to ever be able to buy a tax lien in Arizona. Same with Colorado, same with several states. And so if that is your defining criteria, it's going to make that decision for you. Now, if you're willing to travel and you want to own real estate, then there's, versus owning just or earning just the interest, then your potential investment area opens up considerably. And so, depending on what your end goal is, will define typically what most people will choose to attend or buy. And so, if you're after property, naturally the quickest way to owning that property through tax sales is to go to a tax deed auction. Go buy it directly from the county. A much longer play is, buy the liens, and, anywhere between 1% and 5% of those liens might end up being real estate. And then you got the hybrid status in the middle, right, where you will have to wait, but you're probably going to get into the property for less than attending a tax deed sale. So it's kind of that game of how much are you wanting to make versus how long you're willing to wait, versus what is your ultimate end strategy will kind of help define which type of asset you're after.
Well, and I
Wow.
think you also need to weigh how much you have to invest, because coming into a tax deed sale is going to take more upfront capital than maybe investing in a tax lien. Because on a deed specifically, deeds are usually already delinquent for X amount of years, depending upon the state. So, if you just look at that in itself, you have 3 years of delinquencies on a property, plus all the fees and the compiled interest, all of that combined, that's going to take a larger chunk of money to put toward that. And then you've got your titling fees and everything post the deed acquisition process. It really depends where you land in that bucket, as Brian was explaining. I'm just trying to expand a little bit more, because
Awesome.
if you're coming in and you've got $1,000, that's not going to be really ideal to go into the deed market. If you're coming in with 10,000, yeah, it's possible. A little more feasible, basically. So it really depends on how the investor's coming in and what kind of monetary strategy that they have.
Awesome. Awesome.